Hey guys, welcome back to the channel. We're back with another top 5 video, and today we're going to be looking at Australian ETFs or exchange traded funds going into 2022. If you're new to investing, ETFs are essentially just a basket of stocks. When you buy a share of an ETF, you're buying a piece of a portfolio that can hold up to 50 to 1,000 stocks. Some ETFs track particular sectors like technology, emerging markets, and healthcare, but the most popular ETFs are ones that track a broad market index like the ASX 200 or the S&P 500. Their only goal is to copy the performance of the index by mimicking the companies that they own. And these broad market ETFs are commonly referred to as index funds. I think index funds have grown so much in popularity over the last few years for a couple of reasons. One, because the GOAT Warren Buffett is a huge advocate for buying and holding index funds to gradually build wealth over time. And two, I think more investors are swaying towards passive investing over picking stocks just because of how easy it is to be a passive investor. More people are choosing just to dollar cost average into index funds, which is a proven strategy to do well over time. Alright, let's get into it. So the 5 ETFs we'll be looking at today are all broad market index funds. A couple are from the US, a couple are from Australia, and we also have a global ETF as well. But each of these funds are based in Australia and are listed on the ASX. If you enjoyed the video and you want to support me, please consider hitting that like button and subscribing to the channel. Okay, first up, we have an Australian index fund from Blackrock. This ETF tracks the ASX 200 index, which is made up of the largest 200 businesses in Australia. And it has the ticker symbol IOZ. If we look at the home page, it tells us that this fund gives an investor low cost access to the largest 200 companies in a single share. And its objective is to provide the same performance as the ASX 200 over time. This ETF's performance over time has been solid, returning about 10% a year to investors over 10 years and about 8% a year since its inception in 2010. Most of the businesses in this ETF are household names in Australia like Commonwealth Bank, Afterpay, Woolies and Telstra. And if you wanted to look at all 200 companies and their weightings within the portfolio, you can go to their holdings and all 200 businesses will be listed. Another great thing about broad market ETFs are the low management fees. Due to being passively managed, most broad market ETFs charge really low fees. BlackRock are pretty good for charging low fees, and for the IOZ ETF they charge 0.09% per year, which is around 90 cents per $1,000 you have invested. Not very noticeable at all. Overall, this ETF is a great addition to a passive portfolio if you want low cost exposure to the largest businesses in Australia. Alright, coming up next we have an ETF from the US, and that is the mighty Blackrock S&P 500 ETF with the ticker symbol IVV. This fund is arguably the best and most popular ETF today across the globe. It holds the 500 largest businesses in the US, including powerhouse companies like Apple, Google, Amazon, Nvidia, and Tesla. The man himself, Warren Buffett, recommends the S&P 500 index fund to most investors, and he gives an example of what would have happened if you had bought an S&P 500 index fund back when he bought his first stock many years ago. Have a listen.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
If we look at the performance over the last 10 years, IVV has returned an amazing 20% a year to investors. I'm not sure if it'll return 20% a year for the next 10 years, but if I had to guess, I think the S&P 500 will likely do well for the next few decades, driven by all the powerhouse companies in the US. When you buy the S&P 500, you're essentially buying the US market, as the S&P 500 takes up about 80% of the total US market. So you're basically betting on America, as Buffett would say. And for the fees, BlackRock charge 0.04%, or around 40 cents per $1,000 invested. So if you want exposure to the US market and some of the biggest companies in the world today, then you won't do much better than this ETF. Okay, coming in at number 3, we have our global ETF, and that is the Vanguard International Shares ETF with the ticker symbol VGS. Unlike the other funds, this ETF holds businesses across many countries. It has holdings in the US, Japan, the UK, Canada, France, Switzerland, and many others. It is primarily US based, with 70% of the portfolio being US companies like Apple, Amazon, Tesla, and Google. But it also has hundreds of holdings in other countries like Nestle, Louis Vuitton, Toyota, and Sony. This ETF has a massive amount of holdings with over 1,400 stocks in the portfolio, so it's pretty well diversified across the whole world. In terms of performance, this ETF is relatively new, so we only have the performance for the last 5 years, which is around 15% per year. And since the ETF's inception in 2014, it's around 14% a year. And finally, for the fees, Vanguard charged 0.18% per year, which is around $1.80 per $1,000 you have invested. Overall, if you want some global exposure to companies all over the world, then this ETF is a great ETF to look into. It holds pretty much all of the biggest companies in the world in the portfolio, and if you believe that the entire world economy will be better off in 30 or 40 years, then a global ETF could be a great addition to your passive portfolio. Alright, next up we have another Australian ETF, and that is the VanEck ASX Midcap ETF with the ticker symbol MVE. This ETF seeks to track the ASX Midcap 50, which is made up of the companies in the ASX 100 excluding the top 50. So essentially, if you have the top 100 businesses in Australia by market cap, this ETF owns numbers 51 to 100 and ignores the largest 50. This is by far the most concentrated portfolio on the list with only 50 businesses, but it's still a solid portfolio with the likes of Domino's Pizza, JB Hi-Fi, A2 Milk, and Reese. If we look at the bio, it says the ASX Midcap 50 is the sweet spot of the Australian equity universe and represents companies with the spirit of small companies with the maturity of large companies. For the performance, the index has done pretty well, returning around 13% a year over 10 years. When it comes to fees, this ETF is a little more expensive compared to the others, but it's still reasonably cheap at 0.45% or $4.50 per $1,000 invested. Overall, I think this is a solid choice for an Aussie ETF. I personally like the idea of excluding the large businesses and having exposure to mid-cap and small-cap businesses, especially in good market conditions, as the small caps tend to outperform the large caps. Alright, last but not least, the final ETF on the list today is the BetaShares Nasdaq 100 ETF with the ticker symbol NDQ. This ETF aims to track the Nasdaq 100, which is a broad market index in the US that tracks the 100 largest non-financial companies listed on the Nasdaq stock exchange. The fund is primarily made up of big tech companies, with over 50% of the portfolio being in tech, with all the usual suspects like Apple, Google, and Tesla. But it also owns retailers like Costco and Starbucks. This has been one of the best performing ETFs for the last few years. Their returns have been insane because of the big tech boom over the last decade. And since 2015, it's returned 23% a year to investors. And over the last 5 years, 30% a year. Those returns are pretty nuts, and it just highlights how much of a run tech companies have been on since the 2008 financial crisis. In saying that, if you believe tech companies are here to stay, and the biggest companies in the world will stay that way for the next few decades, then this ETF is probably one of the best ETFs you can buy. If you're worried about buying the market at all-time highs, just dollar cost average every few months and build up your position over time. I've said this before on previous videos that I've personally moved away from buying ETFs, and I sold all of my broad market index funds to go 100% into individual stocks. Not because I lost conviction in passive investing, but because I really enjoy picking stocks. And if I had to pick an ETF to passive invest in, NDQ is probably my favourite ETF on the list. But that's just because I'm really bullish on tech companies long term, and I don't really like financial companies. And finally, for the fees, they charge 0.48% a year. Overall, NDQ is one of the best ETFs on the ASX. The 100 businesses inside it may come and go, but the index will likely march on year after year, going through ups and downs. We may be in a bubble like some say, and the market may be overvalued, but the market has been overvalued many times in the past. However, history shows the market always recovers and it always keeps marching higher. And the best companies with loads of cash and no debt are the ones that survive the crashes. Pretty much all of the companies in the top 10 of the NDQ meet that criteria, so I think over the long term the index will do well, only time will tell. Okay, so that's it for the top 5. We have 2 Australian, 2 US and 1 global ETF. I know it can get confusing, but yes, all of these funds are based in Australia, bought with Australian dollars and listed on the Australian Stock Exchange. You don't have to stress about buying into funds in other countries and their tax implications. You can treat these ETFs just like any other Australian shares on the market. In regards to the question I get asked a lot, which is what ETF should I buy? I think the best response to that is another question, which is what investor do you want to be and what's your strategy? Do you want to be concentrated in a small sector of businesses like the NDQ? Or do you want to be diversified across many countries and many sectors, in which case you could buy all 5 ETFs in equal amounts? What's right for one person might not be right for another person, so ask yourself, what type of investor do you want to be? If you have any questions about what type of investor you want to be, or if you're not sure, let me know in the comments down below. I reply to every single comment and I'd love to help you out if you're unsure. I just want to say thank you so much for watching the video all the way to the end. If you enjoyed the video or if you learned something new, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one, or you want to join our little community, hit that subscribe button and tap the little bell. And if you're still bored, I'll put another video up in the corner to watch after this one that I think you'll find interesting. If I don't see you before the new year, have an amazing Christmas and holiday period with your friends and family. It's been an absolute pleasure making videos for you guys this year, and I plan on having an even bigger year next year. I'll do my best to bring you more content ASAP and to not take any time off during the holiday period. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. Thank you guys again so much for all of your support, and I'll see you guys in the next one.